Hey there, and welcome. Today, we're going to break down a really fascinating economic scenario, one that pretty much flips all the traditional financial advice on its head. We're talking about an investment strategy for a very specific and very challenging world. Let's dive right in.
So let's just start with a huge question. What if that whole playbook you've been taught, diversify your portfolio, buy and hold for the long term, trust in bonds, what if it just stops working? What if we find ourselves in a period so strange that all the old rules actually become a liability? That's the core idea we're digging into.
And that leads us to this central concept, the fire and ice problem. Now, I know it sounds like something straight out of a fantasy novel, but trust me, it describes a very real and incredibly tricky economic sequence of events. So, what is it exactly? Well, you've got two parts. First comes the ice phase. This is a deep, deflationary crash. We're talking stocks, real estate, crypto, pretty much everything is plummeting in price. Then, to fight that crash, the authorities respond with fire, and that's a massive, maybe even unprecedented wave of money printing that ends up devaluing the currency and sparking some serious inflation. Two polar opposites happening back to back. Now this is where the core dilemma comes in, the real catch-22. During that ice crash, assets like cash and bonds are your best friends, right? They hold their value while everything else is collapsing. But the very moment the fire starts and those printing presses get turned on, that same cash and those same bonds get absolutely torched by inflation. The thing that just saved you suddenly becomes your single biggest risk.
So, this massive problem forces a complete shift in how you think about things. Trying to navigate a fire and ice world means you need a totally new goal for your investments.
And this is maybe the most important point of this entire explainer. Your main objective completely shifts. It's no longer about chasing high returns or trying to grow your wealth as fast as possible. It becomes purely about preservation, making sure that a dollar you have today can buy the same amount of stuff a year from now, no matter what happens. That's the key mindset change. Okay, so if the goal is preservation, how on earth do you achieve it? Well, this is where a very specific set of tools comes into play. People often call them hard assets. Basically, tangible things that can't just be printed out of thin air. First up, you've got the classics, precious metals. Gold has for centuries been seen as insurance against mistakes made by central banks. It tends to hold its ground during the ice crash, and then it can really take off during the fire of currency devaluation. And then you have silver, which adds another layer. It's way more volatile, sure, but because of its monetary history, it can sometimes outperform gold when inflation really starts to run hot. Next, we have commodities. We're talking about the real, physical stuff that powers our entire world. Things like energy, food, and industrial metals. See, when trillions of new dollars get printed, that money has to go somewhere, and it often ends up chasing the essential goods. After all, people always need to eat. They need to heat their homes. The risk, of course, is that a really deep ice crash could crush demand for a little while before that inflationary fire really gets going.
And this brings us to a more modern contender, Bitcoin. The whole thesis here is actually pretty simple. Its supply is mathematically capped at 21 million coins, forever. That makes it the literal opposite of currencies that can be printed into infinity. It was almost designed for the fire phase, but, and this is a big but, the risk is obvious. It is incredibly volatile, and in that initial ice crash, it often gets sold off hard, just like any other tech asset.
Okay, so it's not all about hoarding gold bars and barrels of oil. Traditional assets like stocks and real estate can definitely have a place here, but you have to approach them with a much smarter, more nuanced strategy. Let's see how that works. The way you play real estate in this kind of scenario is absolutely fascinating. It isn't just about owning a building. It's about owning it with the right kind of debt. If you have a 30-year fixed-rate mortgage, that fire phase of high inflation can actually become your best friend. Your monthly payment stays the exact same, but the real value of that debt is shrinking every single year, all while your property's value and the rent you're collecting are likely going up with inflation.
So what about the stock market? Well, in this world, it's crystal clear that not all stocks are created equal. You want to stay away from companies that are burning through cash or are loaded up with a ton of debt. Instead, you're looking for businesses that have something called pricing power. That's the ability to raise their prices to match inflation without losing all their customers. Think about the brands you buy no matter what. That's pricing power.
All right, so we've got all these different pieces on the board. Cash, gold, commodities, some very specific types of stocks.
How in the world do you put them all together into a single, coherent plan? Well, that is where the barbell strategy comes in.
The idea sounds a little weird at first, but it's actually pretty simple. You want to avoid the mushy middle ground completely and focus only on the two extremes. You build your portfolio like, well, a barbell, with heavy weights on each end and just a thin bar in between. One side is all about extreme safety, and the other is all about extreme opportunity.
And here's what that looks like in the real world. On one end of your barbell, you've got your ultra-safe stuff. Cash, short-term government bills. This is your ICE protection. It makes sure you survive the crash, and it gives you what investors call dry powder, which is just cash on the sidelines, ready to buy up other assets when they get incredibly cheap. Then on the other end, you've got your fire protection. Gold, Bitcoin, commodities. These are the assets that are poised to do really well when the money printing kicks into high gear and the currency starts to lose its value.
And that brings us to the final and maybe most critical warning. The single biggest mistake you can make in a fire and ice world isn't necessarily getting the timing of the crash wrong. It's staying in those safe assets after the crash is over and the response has already begun. That's when your purchasing power can just disappear right before your very eyes.
So that's the framework. It's a strategy that's built for a world of extremes, one that's focused on preservation above all else. And it really leaves us with a final thought to chew on. If you were actually faced with this exact scenario, how would you decide to balance your barbell? Thanks so much for tuning in.